Welcome to the Resource Consumption Accounting Introduction Series Part 3, Resource Consumption Accounting Model Overview. This presentation is the third in a series of presentations introducing RCA and its principles, which are designed to create improved information for managerial decision-making and enterprise optimization. I'm Larry White, Executive Director of the RCA Institute. This presentation will take about 10 minutes. You should recall this slide from previous presentations. Very quickly, resource consumption accounting takes its key principles from German management accounting methods known as Grenzplan, Kosten, Rechnen, or flexible cost planning and control. RCA acquires additional capability by integrating a strict form of activity-based costing where detailed process insights are needed. RCA creates an integrated economic model of operations for decision-making by first applying operational resource flows throughout your organization and then applying cost. This improves its usability and maintainability. It becomes an operational tool rather than merely an accounting and finance control mechanism. In July 2009, the International Federation of Accountants published an International Good Practice Guide titled Evaluating and Improving Costing in Organizations, and also a companion information paper, a Costing Levels Continuum Maturity Model. RCA was evaluated as the most sophisticated approach to cost modeling short of full real-time simulation in the information paper. The top half of this chart is from the IFAC information paper. The RCA Institute, which was on the team that drafted the Good Practice Guide and reviewed the information paper, has proposed a second dimension, which is on the bottom half. All of the information is in the information paper supporting marginal decision-making. Let's look at the model and get a sense of how it is structured and how information is generated. This diagram is part of an RCA storyboard for 5 organizational components, which are in green. 4 are support and 1 is production. Notice the P or the S before the title of the block. And there are 7 resource pools or work centers, which are in blue. 5 are support and 2 are production. The pink arrows show where activities are used to assign cost in the administrative and quality assurance area. You should notice that there are lines between the support resource pools showing they often support each other and lines to the production resource pools. You will also notice some lines apply costs directly to the product level and some common costs are assigned to higher level P&Ls. Note that capacity is indicated in all resource pools. Not shown here, but inherent in RCA logic is that excess capacity would be assigned to higher level P&Ls where it can be managed. I hope you get a sense of an RCA model from this diagram. I often get the reaction that this is complicated. My only answer is, so is your organization. An organizational model must be as complex as necessary to support the organization's managerial decision-making needs. Also, think of the complexity you use for financial accounting, and that is primarily for external reporting, investors and creditors who know far less about your organization than your employees and managers. Do you expect a simple management accounting to yield superior insights? This slide provides an overview of the type of data that is captured for an individual resource pool. In this case, a plant maintenance resource pool. Primary costs are the costs inherent in a work center. Secondary costs are support drawn or consumed by the plant maintenance pool from other resource pools. The primary costs include technician wages, which are proportional since their workload changes almost completely with the output of the resource pool. The supervisor's salary is fixed since it does not change anywhere near as significantly with the output of the resource pool. General material has a fixed and proportional component. Some material is needed to maintain shop equipment, but most is proportional to output. And then shop depreciation, which is fixed. Secondary costs are provided from utilities, HR, and purchasing. Utilities is a resource pool to resource pool assignment with a fixed and proportional component. HR and purchasing are assigned based on quantitative activity drivers, the number of adjustments, and the number of purchase orders. Another example of a secondary cost, which is not shown here, would be shop floor space. The objective of RCA is to produce a marginal profit and loss statement that clearly shows the nature and characteristics of several contribution margins. Costs are assigned to the level in the organization responsible for and capable of taking action to avoid the cost. Cost can be assigned to individual product levels, product group level, the product or service line level, or to the entire organization. The marginal cost column includes only those costs which are proportional. The attributable cost column includes fixed and proportional costs. Costs are included in margins at the level where they are avoidable. For example, the cost of resources needed for the distribution of products C and D are not causally assignable to either product, so they would be included in a product group cost. Think about the job of the resource pool supervisor. Their job is to increase efficiency, essentially creating excess capacity. They are probably not responsible for creating demand for that capacity, and you want to reward them for creating efficiency, not for creative, non-productive busy work to cover up excess capacity. This completes the third in a series of webcasts on resource consumption accounting. I hope you are acquiring increasing understanding of RCA from these presentations. The next in the series is Part 4, RCA in Action, a two-part webcast which features some case studies from RCA users. Please don't hesitate to contact me via the website, by direct email, or by phone to discuss RCA or the RCA Institute. Thank you for listening.